Hey everyone, welcome into Tax Tuesday. My name is Amanda Winalda. This is
Elliot Thomas.
And we are here to bring tax knowledge to the masses. As we are waiting for people to enter our Zoom, we're also live broadcasting on YouTube. We've got a great team in the background. Who do we have joining us today?
Yeah, we got, whoops.
Oh, those are all the attendees. You can't read
Yeah,
their
I hit
names
the wrong
out.
one, right?
Right.
We got Patty, Harry, Jared, Jeffrey, Marie, and Troy.
All right.
I think Troy's doing the
YouTubes. So if you're on the interwebs there watching us live, you got some questions, go ahead and throw them into the chat. Why don't we hear where you're all from? Bob's already jumped ahead of us. He must be a frequent flyer around here. He's from Brea. Go ahead and put into the chat where you're from. Ooh, Chicago, love it. Kissimmee, Florida. I always thought that was such a great name for a town. Yeah.
a romantic. Hawaii, Atlanta, San Diego, Wisconsin.
Diego.
Oof.
Hope you're a San Diego Waves fan. Shameless plug for my stepdaughter plays for that team. Brooklyn. What's up, Brooklyn?
Hong Kong. Pretty cool.
Detroit. I've been to Detroit too.
I've been to the airport.
I've been to the Detroit airport. Yes, that's true. It's a hub. Tampa. Please share the YouTube link. Diva, yes, we can do that for you. We can share the YouTube link in the chat there. How this is gonna work is we do have some rules because we are tax attorneys and we are talking about tax, which is really just a bunch of rules. So we have rules for Tax Tuesday as well. There is a live Q&A feature. So if you go down to the bottom, if you're joining us on Zoom, please put your questions into Q&A. Now, these don't have to have anything to do with what we're talking about. Elliot here has pre-picked out 8 questions that we'll be going over. Feel free to ask whatever question you want in the Q&A or on YouTube, and our team will do our best to help you out, which is actually pretty good because we've got tax and legal under one roof. We'll do
On
it
one roof.
under one roof.
Absolutely.
Elliot wore deodorant today, so thank you, sir.
Yeah, there's a bonus.
If you want your question to be featured on the next episode or a future episode of Tax Tuesday, then you can email that into us at, you guessed it, taxtuesday@andersonadvisors.com. And if you need a more detailed response, please consider becoming a platinum or tax client. This forum, we've got preset questions. It's designed to be fast and fun and educational. So let's get into our questions. First one, we're gonna go through all the questions so you know when to pay attention and know when you can zone out. If I'm still working for the company that sponsors my 401k when I turn 73, even if it's part-time, do I need to take RMDs or required minimum distributions from that account? That's the first part of the question. And then second is, once my Roth 401k is quote unquote seasoned for 5 years, if I roll it over to another Roth IRA account I have already had for 5 years, am I still able to take out the profits tax free? So double question there. Yep. 2 for 1.
Yes, a lot of that going on today. I am looking at a couple different commercial rental properties. One of them is in an opportunity zone in Florida. What are the benefits / tax advantages of purchasing a property in an opportunity zone? Are there any downsides?
Opportunity zones went away for a while. Well, they didn't technically go away, but the tax benefit for them went away, or was
it's
not.
It's starting to wind down, exactly.
Winding down. That's better
terminology. But we're going to have a recharge of it coming up.
Making a comeback. Okay, this one's a long one, so bear with us. My husband and I file separately. I itemize, and my accountant said because I itemize, my husband must also itemize, which is worse for him as he loses out on the standard deduction. Is there any way around this? In addition, the IRS wants to know my salary on his return, which then leads to him owing tons of additional taxes. How can this be? Why would he be taxed on my income? I'm already being taxed on my income. So this year, he left my salary blank on his tax return. Will this come back to bite him and incur fees? This doesn't make sense. We file separately for many reasons, including me having rentals and he has child support and other things affecting his return. Neither of us want to be on the hook financially for the other person's obligations and responsibilities. There's a lot there, but this is actually a very common question that we're going to dig into today.
I was a passive investor in a multi-family unit deal. The property was sold and my CPA informed me that I have capital gains tax of $55,000 for 2025. Anything I can do to reduce this tax? If not, what could I have done differently?
Oh, so many things.
Yep.
Oh, so many things. How come I got both long ones? You did that on purpose, huh? I'm investing $250K in a software startup, pre-Series A. The founders say it qualifies under Section 1202 as a qualified small business stock, or QSBS. Let's say the stock grows 10x over the next 10 years, so my stock becomes worth $2.5 million. So 10 years from now, how do I prove to the IRS that the profit should be tax-free under Section 1202? Do I just document it now and hope they agree with when I file an 8949 when I sell? Crossing your fingers and hoping isn't generally a good idea with the IRS, but we'll show you what to do. Question goes on to say, it seems like there is no assurances they'll agree, and the profits, though not subject to income tax, still become part of my estate, potentially subject to estate tax. Is it just easier investing using my Roth and ensure that all future gains will be income tax free? So if you don't know what QSBS, we'll be explaining that as well, but this was actually a fun one to work through.
Anderson created my limited partnership and general partnership structure. My questions are, which entity has to create or issue a K-1 and who prepares it for me? Number two, when preparing the 1065 tax return, who do I list as the limited partner, me or the entity? This is my first year, first time doing business filing. It's a little confused and needs some guidance. We're happy to do that.
Yeah. We got some very complicated questions and then even some basic ones. So we're here for the
nice mixture.
For you, the people. Yeah.
Exactly.
Please discuss the 20% accumulation. You did that on purpose, didn't you? Earning tax, AET for C corporations, and provide strategies if we want to hold more than $250,000 in net profit resulting from property management and related. And the final question.
I invested in education for several businesses last year. None have come to fruition yet. Got it.
You got it.
Is the education able to be claimed on 2025 taxes? Also, I filed without any of the education being claimed, so I was wondering if I could amend my taxes at some point this year.
Oh, yeah.
Common
Amendment's going to be necessary to get that on that 2025 return. So, great questions. That's what we've got coming up for you. In the meantime, please go to our founding partner, Clint. I do that every time. Literally every time. It's not a hard name to say.
C squared.
C squared. That's a good one. His YouTube channel, Real Estate and Asset Protection, as well as Toby Mathis. If you're on YouTube, this is his channel. And so we do a lot of tax and asset protection. Miss Patty Perry has put into the chat if you need links to those channels right there. And look we've got some major Anderson stars right there.
Look penniless.
Look penniless.
Don't have to look it.
Hey, we wanna look like we don't have anything, so we take that target off our back. And then if you'd like to even come see us live and in person, Elliot gives great autographs. The line is usually out the door. You can come to our next live event. It's going to be in Dallas, Texas, July 30th through August 1st. It's only $99 to attend. Bring a friend. Bring many friends. We love it.
Yeah.
Y'all can come out and see us. Use the code TaxTuesday or this QR code to get your tickets. And if you can't make it out to Dallas to see us, we've got a lot of free education online in our webinars. We do a tax and asset protection event almost every single Saturday. It's about 8 hours of drinking through a fire hose. You get the first morning asset protection, the afternoon, some tax, some estate planning. It's really great. We get a lot of clients that come through there that watch those multiple times because every time you watch, you just pick up a little bit more. So those are great to join as well. And if you're ready to become a client, use this QR code to schedule your free strategy session. This is 45 minutes with a business strategist that will take down all of your existing assets, all of your future plans, and create an asset protection structure with built-in tax benefits because, again, tax and legal under one roof. And get started with us. All right, let's get into it. If I'm still working for the company that sponsors my 401k when I turn 73, even if I'm working part-time, do I need to take RMDs from that account? Once my Roth 401k is seasoned, for 5 years, if I roll it over to another Roth IRA account I have already had for 5 years, am I able to still take out the profits tax-free? So let's do this one at a time. First, what are RMDs, required minimum distributions, and when do they trigger, and why do we have to even take them?
So they are, just as they sound, a required amount that you have to take out of a retirement plan. So the IRS doesn't want you going into retirement and never ever draining out those retirement plans, such as a 401k or an IRA. So we have these minimal amounts that one has to take out. And it typically happens right when you turn 27, or excuse me, 27. When you're 73.
Only that was the retirement age,
Right?
guys.
As if. But at 73, approximately, you're going to start taking out this required amount. How is that amount determined? It's the amount of asset value that you have, the balance in your retirement account, divided by what the IRS actuarial tables say, how many years you have left in your life. And so it's not
Sounds like a depressing exercise.
not the best calculation, because every year it gets a little bit longer or shorter, I should say, on the denominator, how much time they think you have.
How often do they update those?
Not very often. They haven't needed to, because we keep expiring in general. So, point being, but that's how they calculate it. At the end of the year, divided by how many years they think you have left, and that's the minimum amount that you have to take out. Now,
I need to start taking them the year we turn 73.
Unless, in this case, if you are still working for the sponsor of that plan, well, no, you don't have to take an RMD out of this 401k. So we passed the bullet on that one, dodged the bullet, so we're good there. That's one. Now, there is, of course, an exception, because this is the U.S. tax code.
Yeah, always an exception.
Another exception to the exception is if you own over 5% of that business. So if they own over 5% of this entity that's sponsoring the 401k, well, then all of a sudden they say, no, we're not. When you turn 73, you got to start taking the RMD.
Yeah. So if you've got a solo 401k, which by definition, you are the owner of that business, then you're going to still have to take those required minimum distributions when you turn 73. Now, with the Roth 401k, there's these 5-year seasoning rules. So seasoning meaning how long the funds are in the account, not paprika, cumin, turmeric.
No, it's fun.
Not the tasty seasonings.
No, not at all.
So what's the general rule with the Roth and this 5-year seasoning period?
So the idea here is the IRS doesn't want people contributing to a Roth and then immediately taking back out. They say, look, just hold it in there for 5 years. That's all we're asking. And once it's in there and it's seasoned, then, as they point out here, it's been seasoned for 5 years, and they roll over into another Roth. It doesn't matter if the other one's been seasoned or not for 5 years. You have a Roth, it's been seasoned, that's all the IRS is asking. And so if you roll into other Roths, you're okay typically. Not going to have a problem with that. If you were to take out early, you might get hit with a 10% penalty on that. So that's why why the IRS just doesn't want people taking in and out into these Roths.
Mm-hmm. So if the first Roth is seasoned for 5 years and you roll into, let's say, a brand new Roth, maybe you're setting it up, you're going from your 401k to a self-directed IRA.
You're okay there.
If it's brand new, it's still seasoned 5 years in the first one.
Yeah, because you have some Roth that met the standard of 5 years, then you're okay.
Can I split up that 5 years? So if I've had 2 years in one and then I roll over and leave it for 3 more years, does that count as the 5 total, or does it need to be in the one?
Typically, it needs to stay in the one. I guess I haven't actually seen a case on it, but I think it has to stay in that one Roth for 5 years.
All right. So wait 5 years before you roll that over.
Yep.
Okay, I'm looking at a couple different commercial rental properties. One of them is in an opportunity zone in Florida. What are the benefits, tax advantages of purchasing a property in an opportunity zone, and are there any downsides? So let's first start off with kind of the historical of the opportunity zone. What is it? It came out of that Tax Cuts and Jobs Act way back in 2018. There essentially, states were tasked with identifying certain areas of their state that would be an opportunity zone. Now, these could be rural areas, these could be urban areas, but essentially they were areas that needed investment, that they were trying to incentivize investors into putting money in and building it up. I think downtown Las Vegas was an opportunity zone.
It could have been.
Just over here in the north. So and there were a lot of tax benefits with that, but it was like a lot of tax benefits. There were sunset periods. It was dwindling returns the longer you went on, or it wasn't so much as long as you were in it, it was that you needed to be in it for a very long time. So if you didn't get in early, the benefits went down. But this new big, beautiful bill reinvigorated the opportunity zone.
So yes, the original is still available, but what it's saying is that you can have deferral of, because this all starts with capital gains. You have to have earned capital gains, you put it into the fund, you get to defer paying tax on those capital gains. And it is just a deferral, it's not an exclusion. The first round started 2017, 2018, that's gonna end at the end of this year, December 31st of 2026. So taxpayers out there could be invested in one of these and have capital gains, and now at the end of the year, they're gonna have to pay taxes finally on those things that they may have invested back in 2018. Now, if they've held that investment for a total of over 10 years, they don't have to pay any tax on the appreciation. That's one of the carrot sticks items that we have going on with this. It was relatively popular. I did a little bit of research to see how well were these things working, and there's mixed reviews and results, I guess you would say. Some places it did bring a lot of value in other areas, maybe not so much. Nonetheless, they decided to give it a second round of it. We have what we call Opportunity Zone Fund 2.0. That starts January 1st, 2027. What's going to be different there is that you put in your capital gains. And remember, this always comes from capital gains that you earned during the tax year. You put it into the fund, and that will defer it for up to 5 years. And if you do it right away for those 5 years, you can get an artificial basis of 10%. So if we had
kind of like a step up in basis.
Is exactly what it is. If you had $100 of capital gain, you put it in for 5 years. At that 5-year mark, you'll pay tax on only $90. So you get that benefit. And again, if you hold it for a full 10 years, any appreciation that happens in that investment, you're not going to pay any tax at all. But they also said, well, we noticed that there's a difference. We're getting a lot of it in the urban areas, but not so much in the rural. So they made a whole different pathway for rural investors, and they say pretty much the same year or same thing. You put in for your capital gains for 5 years, you're going to get an artificial stepped up basis. It's going to be 30% though. So instead of 100, it's now going to be $70 that you'll pay tax on. And again, if you hold it for a total of 10 years, no tax on that appreciation. So there's a lot of incentive for these type of things. Two different paths going on here. And additionally, in that rural area, one of the stipulations is that you improve by 50% the value. What does that mean? If you went in, let's say, bought a rental property, and the building itself was worth $20,000, you'd only have to put an extra $10,000. Whereas in the other traditional opportunity zones, if you have a building worth $100,000, you'd have to put an extra $100,000. You have to double the fair market value of that within 30 months. So couple different variations to try and stimulate more investment into these areas. But the key is you have to have that capital gain invested within 180 days. We're going to hear more about this because when we get to about June 30th, we have about 180 days left in the year. So as we get longer, deeper into the end of the year, we can start taking our capital gains and investing them January 1st, probably January 2nd, depending on whatever day these accounts are open, and immediately start deferring it for another 5 years. Can we roll over from the old opportunity zone that we have now into this new one? No. We're going to have to pay tax at the end of December. But if you have capital gains that you've earned here in the last half of 26, you can move it into one of these starting very early in 27, but you got to get right on it because you only have 180 days to get it in there. We're going to, again, hear more and more about this as we get towards the end of the year for those who have a lot of capital gains. Maybe they got it from stocks and they want to get into real estate or something of that nature. So it gives you some flexibility of changing your investment. It's not an exclusion, but you get 5 years of deferral, stepped up basis as Amanda put up here on the screen. So pretty good deal.
It's actually a lot better than the original.
It is, yeah. We had this stepped up basis in the original, but it phased out really, really quick. I think it was by 2019 we didn't have it.
Yeah, but if you didn't get in early on, you didn't have the ability to hold it even 10 years because it ended 2026. Yeah,
you'll still, the deferral ends in 2026, but you can still, if you've had it for 10 years, if you hold it in 2028, you'll still get to collect it 10 years. Yeah,
that's good then.
Yeah,
but you can't double dip.
No,
Can't double dip.
No.
And in terms of if you're doing this, there are all kind of opportunity zone funds out there where you can be a passive investor, put your money in. You're relying on somebody else to do that. How much was it that you had to improve the property?
50% rural,
50%.
100% in the urban.
50%.
Mm-hmm.
So you're relying on somebody else to make those. You can create these yourself. And what you do, you need a C or an S corp.
Or a partnership.
Or a partnership. Can't be a disregarded entity. And then it's not as even strict as a 1031. This is kind of like a 1031. It's not even that strict. You can receive the funds to your personal account and then dump it into that CS or corp or partnership. You don't have to use anything like a qualified mediator, anything like that. But you do need to have that zone fund set up through a business entity, and there needs to be specific language in the operating agreement and the bylaws to make sure that it ends up ultimately qualifying for this.
Also, another little aspect to the original question we had, it's one of these properties we're looking at happens to be a zone in Florida. So they're already looking at a property. You need to have the fund set up before you acquire that property. In other words, don't go out and purchase a property. Oh, it's in a zone. We can't just move that property into the fund. The property must be purchased by the fund itself. So if you already own a property, it's too late to take advantage of that. You got to have it purchased by the fund. We ran into a couple of those the first round. I imagine we'll run into that problem again the second round.
Yeah, logistically, it's a big tax benefit. So you need to make sure that on the law side, you're crossing your, I always say crossing your I's and dotting your T's,
I know
which is incorrect. So
I's and T's have to look good.
So those are the benefits. If you can tie up that capital for that long, great tax benefits. The downsides are you're tying up that capital for that long. So if you're somebody who likes to set it and forget it, and 10 years from now you can look up, you could have a great tax savings. If you're someone who likes to make market moves more quickly, that would be the downside here.
Also, it's dependent, as you said, maybe you'll give it to a fund for them to invest. You're really hands off at that point if someone else is taking care of it. And that might be a good thing. Maybe they have done a lot of research and they know what they're doing. They know the numbers. And so that you'll get that positivity, but you are definitely hands off. You're not going to be able to tell them, when to buy, sell, whatever, how they invest it. So just keep that in mind too.
All right. My husband and I file separately. I itemize, and my accountant said, because I itemize, my husband must itemize, which is worse for him as he loses out on the standard deduction. Is there any way around this? In addition, the IRS wants to know my salary on his return, which then leads to him owing tons of additional taxes. How can this be? Why would he be taxed on my income? I'm already being taxed on my income. I'm actually going to stop there while we deal with all of the questions that we've come to so far. So based on the information so far, we sort of came to the conclusion that this person must live in what's called a community property state. So there are 9 community property states in the United States: California, Nevada, Texas,
Arizona,
Washington, and 3 others.
Idaho. I think Louisiana, and then we go up to the island of Wisconsin. It's all by itself out there.
Wisconsin's not an island.
But as far as
the community property map,
goes all the way from the northwest down to the southwest.
And the alternative is equitable distribution states. And so the difference is that in a community property state, you and your spouse are considered almost as one. So your income and his income are, once you earn it, it belongs to both of you. So that you earn $1, 50% of it is yours, 50% of it is his. He earns $1, 50 cents is yours, 50 cents is his. So when you are reporting on your tax return, whatever software your CPA or you are using, it's looking at what state you live in. And then if you live in a community property state, it is then prompting you to have each other's income on your separate tax returns, even if you're filing separately, because his income is your income and your income is his income. Does that result in actually more tax overall? No.
No, I mean, the same taxable income is going to show up on the, because they have to split that community property income. So whether it's better one way or another, you'll never know until you calculate the difference between married filing, joint married filing, separate.
Yeah, he's not paying more tax you're each paying tax on half of each other's income. So overall, you're paying the same. Now, will potentially, if he makes less than you, will potentially more tax be due with his return versus your return? Yes, but less tax will be due on your return. So that's how it really works. You're not being taxed separately. It's the same.
And that can be visually maybe what might be easier to understand is if spouse A makes $100,000 of W-2 income in this situation, well, they had throughout the year, let's say $20,000 of withholding on that. Now, under this rule of the community property, $50,000 will go over to spouse B. We don't lose that $20,000 that spouse A put in. Okay, there's going to be a attributing of that towards the tax bill, if you will. So you're not going to be double taxed on that other $50,000 that goes over to spouse B. You're going to get credit for the $20,000 that you did pay in. That's why we're saying it's not actually getting taxed twice. We don't have a double taxation going here. It just might be taxed at a different place, i.e. your spouse's, instead of your return, but you'll still get credit for the 20 you put in.
Yeah. You're shifting 50 into his return. He's paying on that 50, but you're not paying on that 50. So overall, you still have the same total tax. It's just being accounted for on a different return. Yeah. Now, secondly, so that's one misconception here. Secondly is that sounds like spouse this year on his tax return when he filed, he left the line item for your salary blank. Will this come back to bite him and incur fees? Yeah.
If you're in a community
property state, it's going to be required. So he needs to go back and amend that. And we totally get it doesn't make sense, and if you are in an equitable distribution state, then you're right, it doesn't make sense. This is not how you should be. But you can a lot of people think that filing separately will result in less taxes overall, and it really is very limited situations where even just the cost of doing a separate tax return is worthwhile.
Yeah, it's rare that married filing separately puts you in a better tax position. And,
there are scenarios.
There's reasons, but there's other reasons other than tax why you're doing it, and we see these coming in here. Perhaps.
Yeah. And so it sounds like you filed separately, stated for many reasons, including you having rentals. We're assuming that separate property rentals that you had before you got married, and then he has child support and undetermined other things affecting his return. Neither of you want to be on the hook financially for the other person's obligations and responsibilities. So I used to practice family law in California. It's a community property state. Child support specifically, if you are not the biological or the legal guardian to his children, meaning you haven't adopted them, then you actually don't have any legal obligation to support them. And so your income is not, or at least should not be, factored in to his child support payments. There's what's called a Dizomaster. It's basically a giant calculator. You put in parent one's information, income, what they pay for health insurance, all these different factors, how much they pay for housing, how much they pay for childcare, etc. And then the other parents, and then it spits out a number. At no point in this Dizomaster is a step parent or the wife of the one spouse included in this calculation. Now, for spousal support, that's a little different. If, in this case, most likely, it's not gonna, if one divorced person is living with another person that has income, then that's an argument to reduce spousal support in many cases. But unless your husband is receiving spousal support, it's a non-issue. If he's the one paying, your income is a non-issue to both child and spousal support. So that's not a reason to necessarily file separately. Now, having separate rentals that are only your separate property, sure, if you wanted to keep things more clean, if he didn't want to pay any tax on your rental income, that could be some. But really, rental income, unless your property is completely paid off, most of the deductions on a rental zero out income in a lot of times. Mm-hmm. So it may not even be that substantial of a benefit here. What are some of the other reasons why people could potentially file married filing separately and have it be a good outcome for them.
Often, again, if one spouse has a lot of education expenses, many times you can defer paying back your Sally Mae or whatever loans they are if you've married filing separately because you're showing less income. Again, because if we are in a community property state, which again we suspect is going on here, you're going to recognize some of that income, but maybe it's still not enough. You could still get a benefit. Maybe you don't have to pay as much back in student loans. That's a popular one I see a lot. It's going to be kind of your one-off situations typically like that. But absent that, again, we have two different considerations. We have the consideration, hey, I don't want to show income because I don't want to pay back my student loans just yet, or at least at the full amount that they're going to require me to do so. And then there's we slide those reasons aside. And then there's, well, what about tax bills? Those are two different things, and they sometimes don't walk hand in hand. There can be competing factors here where you have to pay more tax, but it's giving you the added benefit of not having to pay back, say, student loans or something like that. And we don't know until we calculate.
Yeah, we don't know. If your husband has maybe some IRS issues and you don't want a refund intercepted through one tax return that wouldn't be intercepted through the other, perhaps that could be a reason as well.
Absolutely.
But generally, if you're in a community property state, there really isn't a way to avoid this unless you move or get divorced.
Yep.
Those are generally not solutions, though. Okay, then. I was a passive investor in a multifamily unit deal. The property was sold, and my CPA informed me that I have a capital gains tax due of $55,000 for 2025. Anything I can do to reduce this tax? If not, what could I have done differently? Unfortunately, it is 2026, so there really isn't anything you can do after the fact once the tax year is over. I guess they could buy a property if you filed an extension, because we are still in that in-between spot between April 1 and October 15th. If they bought, they could do like short-term rental loophole and cost seg.
Well, it's still not going to help them for 2025. That's going to be a 26th event. And really, and this was my fault, this question was really supposed to come after the question about the opportunity zone to show a reason, well, that could be something that they could have done. There's nothing we can do for 25 at this point. There really isn't. Maybe you can put into an HSA. I think that had to be by April 15th as well.
If you had a property already that you qualified and could cost seg for.
It would, yes, we could. If we had one,
get one now.
In 25, we could do a cost seg real quick, get it done. And if you were materially participating and it was an act of loss, well, it doesn't even have to be an act of loss. In fact, you don't have to materially participate. You can go ahead, if you had a property, you could have a cost seg done right now, and that would potentially create passive losses, and that would offset your passive income because it's going to pull those passive losses to offset capital, what we call passive capital gains, which is what you have here as a passive investor. So that would be something you could do, yes. Exactly right. If we have property already on our books in 25, and yep, very solid there through the cost seg, and you're right, we don't have to have that study done if we extended until September 15th or October 15th. So that could be a play. If we go back to 2025, along the same line, pick up a property, doesn't have to be active, it can be passive, do a cost seg, same thing. You're going to, what we call lazy 1031, instead of going through formal 1031 proceedings, just pick up another property, create passive losses. Again, in the year of sale of a passive investment like this, you're going to pull those passive losses to help offset that gain of $55,000. Alternatively, you could have done a regular 1031 back then at the time if this was something that you owned the property yourself. Multifamily, we talked, this probably got a syndicate.
Multifamily, probably syndication, passive investor. You don't have a lot of control, and you have no control in that situation, really. And in reality, they may not even let you know that they're going to sell that year, so you don't have a ton of time to plan. You wouldn't even know until, March, January, February of the following year that when you get your K1, that they even sold.
Could be.
So what could you have done differently? Like when you're going into that deal, make figure out what the lines of communication are, what the exit strategy is, what that timeline is, so that you can kind of better prepare and plan as it's coming up and you don't just get surprised going in. Also, what we just talked about, that opportunity zone would have been.
Yes. You had capital gains. That's exactly what an opportunity zone's for. Put capital gains in there. Now, we're towards the end of round one, opportunity zones, and it would only defer to the end of 2026. So December 31st, you're going to have to pay some tax. However, if we'd been able to, in a perfect world, put off this sale until after June 30th of this year, as we got closer to the end of the year, you might be able to move those capital gains within 180 days into Opportunity Zone 2.0, kicking up here in 2027.
Yeah. And on this one for the 1031, that's only actually possible if you take your interest as tenants in common. If you're just passively investing in shares of a partnership, you're not going to be able to 1031 out of it without everybody else. So you'd have to individually take your interest as a tenant in common to do that 1031.
Yeah.
All right. Head on over to Clint Coons' YouTube channel, Real Estate Asset Protection. Looks like we keep freezing, so our apologies for that. If you want to go to Clint's channel, you can subscribe there. We're going to drop those links into the chat. Also, Toby Mathis. Oh, they updated. You get skinny Toby and a little bit chubbier Toby. In both of those, we got to update his little circle shot there. Man has gotten a lot healthier and slimmed down. I barely recognize him some days. I could pass him on the street and I wouldn't even recognize him anymore. But several thousand, probably millions of hours worth of tax, legal, asset protection, advice, and things to think about, things to do your investing and save money while you're doing it. Or you can schedule a free strategy session and talk to one of our business strategists. Use this QR code. It's 45-minute free session where we talk about all of the assets you have, what you're planning to do, so that we can build you a structure to keep you protected from liability with all of those built-in tax strategies. All right, moving on. I'm investing $250K in a software startup, pre-Series A. The founders say it qualifies under Section 1202 as Qualified Small Business Stock, QSBS is that's what it's known as. Let's say the stock grows 10x over the next 10 years. So my stock becomes worth $2.5 million. 10 years from now, how do I prove to the IRS that the profit should be tax-free under Section 1202? Do I just document it and hope? Let's pause there and just go over what is required for this qualified small business stock under Section 1202.
And maybe what it is.
Yeah.
So 1202 is simply a provision that says if you buy stock in a C corporation, we're only talking about C corps, then you later sell it, you don't have to pay any tax on the gain. It started maybe back in the 80s, as I recall. So it's taken a lot of different twists and turns. It used to be you'd get 50%, I think, off, and then it was 75%. Then it was 100%. Now, as of the big, beautiful bill of last July 4th, they have a tiered program for new C corporations that qualify as 1202 stock. And it says, if you invest in one of these stocks, like this questioner is here, $250,000 in a startup, if you hold the stock for 3 years, you get to knock off 50% of the gain, 75% if it's 4 years, 100% if you hold it for over 5 years, that is the stock. What qualifies for it and why, it's the idea is to spur on investment in startup businesses.
Right, I'm going to write that down. Now you have to repeat it.
Yep.
3 years?
50%.
50%.
4 years is 75.
Okay.
And I'll make you guess what 5 years is.
5 years. 100%. 100% of the gain?
Correct. Yeah.
And you only have to hold it 5 years?
5 years. 3 years if you want 50.
Yeah. 4 years if you want 75.
75. Goes to figure. So this is very lucrative. People want to put into it. I haven't been able to see all the new rules, but I imagine because this has been in place for so long that anything that's not covered as far as specific new iterations of this, then they fall back to what the previous rules were. Have run into situations, consultations with clients that had a qualifying stock. They had a good stock, but they wanted to invest it in another one that would qualify. Could they transplant their investment in one into the other and still accrue their time for 5 years? Yes, you can. Ooh. You used to be able to do that. I don't know under the new plan if you can or not, but that was a thing. Maybe stock A, it was doing really well, but now you wanted to move over to this new venture that you thought was going to do even better. You could take the 2 years that you had in stock A and then get 3 years over at stock B. But I don't know if we can still do that or not, but I have had those calls where, and back in the day, you used to be able to do it. But anyway, what this is, and what has also changed is what qualifies. What kind of C corporation? We know it's a C corp. What's that? What's that look like? It has to be a C corp with under 75 million in assets. Is basically what it is. That's one of the criteria. And how much can we go ahead and not have to pay tax on? 15 million or 10% basis, whichever is greater. So it could be more than 15 million. But the basis of what you put in, how much it goes up, then it could be quite a bit more. But in this case, again, we're talking 2.5 million. We're clearly within either of these categories. Those are just some of the caveats that we have. Now, one thing that they also look at, what if you're at 74,900,000 and Amanda puts in $200,000?
We're over.
Now we're over, and you just ruined it, okay? Basically, so now it no longer qualifies. So what they're going to look at is that it was under 75 million when you bought the stock, and then that it was still under 75 million after the stock was issued. That becomes a very important part as well. One of the tests that have to be looked at for this. Those are kind of the parameters of what we have going on. Now, really back to the question, and I don't think we finished it all. Maybe we can start from there.
So now the question becomes, how do you prove to the IRS that the profit should be tax-free under this Section 1202? Do we just document it now and hope that they agree when we file an 8949? Or it seems like there's really no assurances they'll agree. And the profits, though not subject, actually that's the third part of the question. Okay. So how do we prove this? Yeah, you document it now because you don't actually file that 89. There's nothing on the 8949 where you would indicate that you're taking this 1202 qualified small business stock option.
Might make a memo or something like that, but that's not documentation. What you want to know is that, first of all, it was a C corporation, so you have articles of incorporation showing that it was a C corp when you bought the stock. Make sure there's bookkeeping. Because as we just talked about, as far as the $75 million limit, it has to be under $75 million even after they issue the stock and they take your cash or whatever property you put in. So it's based on the assets. So you want to have financials prior to the issuance of the stock and after the issuance of stock. Make sure we have all that. Certainly a stock certificate or some kind of a recording of the legend showing all the stock change, payment of the services, showing that you actually gave them something in return for this stock. As far as on the C corporation side, that is the issuer, again, they're going to want to show a certificate of incorporation showing that they indeed are a C corporation. They're going to want to show their tax returns, their Form 1120s, for the year that they gave out this stock and probably the year when it was cashed out. Financials statements, again, as we pointed out. Calculations, valuations for support of whatever the value was of any assets that were contributed to make sure that the assets weren't over 75 million again that you gave or put us over that mark. So if you gave some kind of asset in return for the stock, we need to have independent valuation what the value of that asset was when it went in at that time. So kind of your common documentation that you would really expect to have if you're running a corporation, a good ship here, that with all the documentation, balance sheets, narratives of any meeting minutes showing that there is an intention to give out 1202 stock would be healthy as well. And maybe from your own investments showing that you had a meeting deciding that you were going to pick it up. Now you have to pick it up as an individual. I'm not saying have a C corporation receive the stock. No, you want to receive it as an individual. It's for you. The next very slippery slope, well, what if I receive it in a partnership as a member of a partnership or an S corporation? Can they receive 1202 stock? They can, but you're getting into dangerous territory where something's going to get done wrong, okay? But it can be done. It doesn't necessarily offend it, but you'd be better off just receiving it individually.
And the 75 million, I put this control group analysis memo. The 75 million actually can incorporate assets from other companies that this C Corp owns if they fall under that control group analysis. So it's not just the assets of that C Corp necessarily.
Yeah, so if C Corp A, the one you're taking a stock, let's say it only has 30 million in assets, but it owns 50 some plus percent of Corporation B that has 100 million. You got to bring that over, and that's going to mess up the calculation here and show far more in excess of the 75 million. So control issues are a problem as well.
All right, the final piece of this question. Although the profits are not subject to income tax, don't they still become part of my estate and potentially subject to estate tax? And the answer is yeah. The money you earn is going to be subject part of your estate unless you're doing some sort of other long-term tax planning that involves pulling funds out of your estate, maybe into irrevocable trusts or whatnot, gifting, but they do become part of your total estate. The good news in that venue is that the estate lifetime exemption is very high right now. It's about $15 million per person. So if you're married, that doubles, and it's indexed to go up for inflation. Now, can that go lower? Yeah, sure. At one point in our lifetimes even, it was as low as $1 million. So like my uncle always says, you got to die in the right year if you want to save that money.
And if your lifetime's a little longer, it even got worse.
So while we can't predict for what future Congresses and administrations will do, the estate tax, the estate exemption is fairly large. That 2.5 snugly fits underneath that without any other additional information on what other assets you have. But the amount over that, the amount over that would be subject to that 40% estate tax. Can we just forget all of this and just do the investment through the Roth so that all future gains would be income tax free?
Quick answer, yes.
Yeah.
You can. Yeah. There's always something you want to make sure it's not some kind of, and I don't even know what this would be, but some type of investment that's going to create unrelated business income tax, but it's very hard to find that scenario because you're just getting shares of stock, just like you invest in IBM or Google or whomever, whatever business, AT&T, et cetera. You're not going to typically run into that, as long as it's not a related party, which so don't invest in your own business.
Yeah, and I know we put this whole crazy list up. Sounds complicated. It's really not. Any corporation that is sophisticated enough to be doing this should know what they're doing, and you as the investor don't have a lot of this to do yourself, right? It's all going to be coming from them. They're going to be providing the financials or whatnot. So if you have the ability to take other funds and invest them in your Roth, now you're saving on taxes in two different places. So it could be more easier and straightforward for you to sort of be super safe and do it in your Roth. But if you have the ability to invest other funds in your Roth, why not be saving on both sides?
Yeah, and in today's environment, if it's a business that's doing this, the other people structuring this business, I can almost guarantee you're aware of the 1202. It's very common. It's been around for a long time. Really meant to encourage especially high-tech business type investments and things like that, but certainly not limited to that. But there are certain limitations. It can't be a business that's based on your own attributes, such as a doctor, a lawyer, accountant, things of that nature. You're maybe consulting
services.
Right, exactly. We want to stay away from those. And there's a lot of medical you can't do as well. I had some clients who did medical software. That's okay. Okay, it might have been in the medical industry, but it wasn't providing medical, diagnosis or anything like that. It was just software that was tracking things. That's all right. That's a good investment. So there's a lot of flexibility. It's actually an area, surprisingly, it's been around for so many years, almost 30 years, I think. Plus, there's only been 23 things out there, private letter rulings or things of that nature that actually mention this. So, and that's astonishingly low in our business of tax.
Yeah, for something that saves you.
Exactly. You'd think they'd talk a lot more about that, but there's not a lot of talk about it.
Yeah.
So, yeah, it's a great plan.
All right. Anderson created my limited partnership and general partnership structure. My questions are: 1, which entity has to create or issue the K1 and who prepares that for me? And 2, I lost my spot. When preparing the 1065 tax return, who do I list as the limited partner, me or the entity? This is my first year doing this. I need some guidance. So this is our general limited partnership structure. So this is your limited partnership. You as the individual are the limited partner. So you're typically owning 80 to 90% though. Limited partners just mean you have limited liability. It doesn't mean that your investment or percentage is limited. This general partner up here is typically going to be a C corporation. Ooh, I guess we're doing a capital R. C corporation. And then they have the remaining percentage there. And so when are we using this? We're typically using this for our traders. If you can't qualify as a real day trader, then you're sort of doing this as a startup, as a side hustle. So you're not doing it continuously. You're not relying on it as your primary source of income. There's a lot of deductions and expenses that you aren't allowed to take on your personal tax return, but you can take them on this C Corp return. And so what happens at the end of the year is that this limited partnership files a 1065, and then it's going to issue a K1 to each of the partners, allocating 10% to the C Corp and 90% to you as an individual.
Exactly. So it's going to be your preparer, whoever's preparing that return.
Doing that for you.
Exactly. That they prepare the K1s with the return itself.
Yeah, it just generates.
It does. Yep.
Typically with the software there. Our final question.
Yes.
I invested in education for several businesses last year. None. How did I mispronounce that word, but not the fruition? None have come to fruition yet. Is the education able to be claimed on 2025 taxes? Also, I filed without any of the education being claimed, so I was wondering if I could amend my taxes at some point this year. Easy part of the question is yes, you can amend your taxes. You can amend up to 3 years if you are expecting a refund. Beyond that, you can still amend. You're just not going to get any money back.
Right, exactly right. But can it be claimed on our 2025 taxes? Well, it depends on what kind of business or how you're trying to take the deduction. If it's on a 1040, well, you said you invested in several new businesses. Now, I assume those are new. That's maybe a wrong assumption. But if it's a new line of business, typically you can't take that on your 1040, can't do it on an S Corp, can't do it on a partnership. You have to do it on a C Corp. And yeah, you could go back and amend that C Corp and pick those up. That's not a problem. But we wouldn't be able to do this on our personal return. It's just not allowed. The courts just don't, the tax return, excuse me, the IRS does not, the tax regulations don't allow for it. It's just one of the parts of our code. But if it was continuing education, you have an S corporation and you've been around for 4 years and it's not a new line of business, it's just continuing education, well, that's something else. And then yes, you could still amend, as Amanda points out, up to 3 years. Could put it on there.
Yeah, so if they made this investment in education in 2025, is it gone?
Even if you didn't go back and amend and pick it up on your 25, you'd probably be able to pick it up. Well, it would need to be a startup cost. So yeah, we got to go back and amend the 25 return. It's not gone, okay? You'll be able to claim it, but we do have to amend.
Or you can set up a C Corp now to run those businesses, and you can claim that education as a startup cost. We like to do it as close to the time period where you made that investment into the education expense, but it doesn't necessarily have to be in that same year. We do like it to be fairly close in time, but generally, you can go back 6, 12 months, so it doesn't have to be in the exact same year. So even early on in 2026, you can start up a C Corp for these new businesses, and you can claim those education costs as startup costs, and you get $5,000 deducted in the first year, and then the rest is amortized over 15 years. So you got to spread it out a little bit, but you eventually do get it all back.
Up to $50,000.
Yes, but if the education for each one is more than 50, then more than one C Corp, buddy.
Yeah.
There you go.
Yeah.
Then we can get it all.
But yeah, the bottom line is you can take advantage of that. It's just a matter of the path that you take, and I'm going to guess it probably is going to require a C corporation.
So head on over to Clint Coons' YouTube channel. We talk about this topic very frequently, or you can go over to Toby Mathis's channel, subscribe, like, you'll get notified for any new videos that pop up. And then if you'd like to join us for our next live event, please do so. It's in Dallas, Texas, July 30th through August 1st.